What if I told you that a single $37,000 trade on a major crypto exchange once sent XRP all the way to $50? Not a glitch. Not a system error. A completely real market event. And that one event mathematically proved something that most XRP holders still do not fully understand. It proved that Tier 1 banks cannot enter this market the way everyone assumes they will. Today we are breaking down exactly what that means, what the math actually shows, and why the DTCC just told every financial institution on the planet to get ready right now. If you hold XRP, this video is for you. This is XRP Verified. Let us get into it. Let us start with an event from August 2023 that most people completely misunderstood. XRP had just been relisted on a major US crypto exchange after a period of restricted trading. When it came back online, the order books were almost completely empty. Razor-thin liquidity on both sides. Then, a single market buy order came in. That order started filling, sweeping through every available sell order on the book one by one. By the time that single order finished executing, it had hit a rogue sell order sitting at exactly $50. The entire move, from normal price levels to $50, was caused by just $37,000 in volume. $37,000. Now I want you to sit with that number for a moment, because that is the key to understanding everything we are going to talk about today. Most people saw that event and said, "Wow, crazy glitch, moving on." But serious analysts looked at that same event and said, "This is a live demonstration of catastrophic slippage. And it is mathematical proof of something much bigger." If $37,000 can send XRP to $50 on a thin order book, what happens when a Tier 1 bank initiates a multi-billion-dollar cross-border settlement using XRP as a bridge asset? The answer is, the entire transaction breaks down. The bank loses control of the price. The settlement fails. And that institution never touches XRP again. This is why serious researchers are now concluding that banks cannot simply plug into on-demand liquidity as passive users and expect it to function at global scale. They will need to hold XRP in their own dedicated liquidity pools, pre-funded, locked, under their own management. The $50 event was not a malfunction. It was a warning and a blueprint at the same time. Let me explain slippage clearly, because this concept is at the heart of everything. When you place a market order, you are asking to buy or sell at whatever price is currently available. In a deep liquid market, your order fills close to the current price. Minimal movement, minimal slippage. But in a thin market, your order starts eating through available sell orders one by one. Each sell order it consumes pushes the price higher. By the time a large order finishes filling, the price can be dramatically different from where it started. That is slippage. For a retail trader buying a few $1,000s of XRP, slippage is annoying but manageable. For a Tier 1 bank executing a $5 billion cross-border transfer, slippage is catastrophic. It means the transaction settles at a completely wrong rate. The bank absorbs massive, unexpected losses. Counterparties receive incorrect amounts, and the entire purpose of using XRP as a bridge, speed and cost efficiency, is completely destroyed. This is why the math leads to one unavoidable conclusion. Banks cannot rely on on-demand market sourcing during peak institutional volumes. They must hold deep, pre-funded XRP liquidity pools under their own control. locked capital, dedicated infrastructure, not passive users, active participants with their own reserves. And here is where it gets very interesting for XRP holders. If thousands of banks are each holding significant XRP reserves, what does that do to the available circulating supply? This is the scenario that most retail investors have not fully modeled out. Let us walk through it step by step. Right now, the XRP that exists in the market is mostly sitting in wallets, on exchanges, available for trading. Floating supply is relatively accessible. Now imagine the moment banks and financial institutions begin formally integrating XRP into their balance sheets and payment pipelines. Each institution needs to fund its own liquidity pool. That XRP gets pulled off exchanges and into institutional custody. It is no longer floating supply, it is locked infrastructure capital. Now scale that across thousands of institutions simultaneously initiating transfers at any given moment. Hundreds of millions of XRP constantly in transit between institutional wallets. Not sitting on exchanges, not available for retail to buy. Constantly moving, constantly locked in settlement. The available trading supply does not just decrease, it dries up. Institutional demand is massive and constant. Available supply is locked in transit. That is the definition of a supply shock, and the revaluation that follows is not speculation. It is a mathematical inevitability. The price must rise to the level required to carry the volume, not because traders are excited, because the system requires it to function. This is why some analysts describe XRP revaluation not as a price prediction, but as a systemic algorithm of necessity. Here is the concept that most people in crypto completely misunderstand. They assume that XRP can do its job as a bridge asset at $5, or $10, or even $20. That assumption is mathematically wrong, and here is exactly why. The depth of a liquidity pool is determined by two things: the number of units available and the price per unit. Total pool depth equals units multiplied by price. If XRP is priced at $20 and there are 500 million XRP in a liquidity pool, that pool has a depth of $10 billion. That sounds large. But global foreign exchange markets process over $7 trillion every single day. A $10 billion pool gets absorbed in seconds. Now consider what happens when trillions of dollars in banking volume, foreign exchange settlements, cross-border transfers, institutional tokenized asset movements, all enter that shallow pool simultaneously. The spread explodes. Slippage becomes uncontrollable. Transactions fail. The system seizes. The only mathematical solution is to increase the depth of the pool to a level where it can absorb institutional volume without breaking. And the only way to increase pool depth at global scale is to increase the unit price of XRP dramatically. $300, $500, higher. These numbers are not hype. They are what the liquidity mathematics of global banking volume actually require. High price is not the reward for XRP holders. High price is the liquidity mechanism that makes the entire system function. That is a fundamentally different way of thinking about XRP valuation, and it is the way institutional analysts are beginning to think about it. Let us talk about timing, because this is where a lot of XRP holders get confused. The Clarity Act, new regulatory frameworks, these things take time to formally implement. People say, nothing will happen until the law is fully in effect. That thinking is wrong. Markets price in the future, not the calendar. In early 2026, U.S. regulators formally classified XRP as a digital commodity. The moment that classification was confirmed, the regulatory risk was legally removed. Tier 1 banks do not sit on their hands waiting for 18 months of bureaucratic implementation. Their legal teams immediately begin reviewing the new framework. Their treasury departments immediately begin modeling XRP integration scenarios. Their technology teams immediately begin infrastructure planning. Accumulation starts on day one. This is why serious analysts expect that the most dramatic price movement will happen well before formal regulatory deadlines are reached. By the time the paperwork is officially complete, the banks will already be positioned. The institutions that move first will have locked in their liquidity pools at significantly lower prices. The institutions that wait will pay dramatically more. Markets do not wait for calendar dates. They move when clarity is established. And clarity, for XRP, is now established. Let us have an honest conversation about Bitcoin and XRP, because understanding the difference is critical for where we go from here. Bitcoin is an extraordinary asset. It has established itself as the premier store of value in the digital asset space. No one is disputing that. But Bitcoin has a fundamental ceiling built into its design. Bitcoin competes for one thing only: a share of global savings. Gold, real estate, cash savings. That is Bitcoin's total addressable market. It is a massive market, but it is a finite and defined market. XRP and programmable utility networks compete for something entirely different. They compete for a share of everything that moves through the global financial system. Cross-border payments, foreign exchange settlement, tokenized asset transfers, corporate treasury management, trade finance, and as artificial intelligence-driven transactions emerge, that market becomes effectively infinite. Bitcoin cannot be programmed to execute these functions. It cannot settle cross-border transactions with built-in compliance. It cannot tokenize real-world assets natively. It cannot serve as a bridge currency in institutional payment corridors. XRP was specifically designed to do all of these things. Now add one more layer to this analysis. XRP is one of only 3 digital assets that has remained in the top 10 of global crypto rankings every single year since its first year of trading. Bitcoin, Ethereum, XRP. That is it. Every other asset has cycled in and out of the top 10. XRP held its position through bull markets, through bear markets, through a 4-year SEC lawsuit that would have destroyed any other project. That is not luck. That is the result of real utility, real partnerships, and a technology that delivers actual value. Now let us talk about the most significant institutional development in this space right now. The DTCC, the Depository Trust and Clearing Corporation, recently made a public statement that every XRP holder needs to understand. For those unfamiliar, the DTCC is the backbone of American financial markets. They operate the world's largest securities depository. The assets they hold and process are valued at over $110 trillion. $110 trillion. And they just publicly stated, blockchain implementation is coming. Institutions need to take action right now. Here is specifically what they announced. They are actively pursuing tokenization of assets across their portfolio, starting with major ETFs, treasury securities, and fixed income instruments. They are building a collateral platform where institutions can exchange collateral at the speed of blockchain networks, reducing friction and simplifying settlement across the entire system. They are committed to interoperability across multiple blockchain networks, both new and legacy systems. And they explicitly said, They are working with multiple Layer 1 and Layer 2 blockchains to ensure institutions can access liquidity on the chains most appropriate for their specific use cases. The DTCC does not make announcements like this casually. When the organization responsible for settling most of the trades in American financial markets says it is moving to blockchain, it is moving to blockchain. And when they say institutions need to act right now, that call to action lands directly on the desks of companies like Ripple. Because Ripple already has the compliance framework, already has the regulatory approvals, already has the banking relationships, already has the technology infrastructure. The race to tokenize $110 trillion has officially begun. And Ripple is already at the starting line. Here is something that does not get nearly enough attention in the XRP community. Finastra, one of the largest financial technology companies in the world, is already a confirmed Ripple partner. Finastra provides banking software and infrastructure to thousands of financial institutions globally. And here is what their own executives have said publicly about how adoption actually works through their platform. Once a bank sets up the infrastructure through a technology provider like Finastra, activating payments on the Ripple network is as close to flipping a switch as you can get. The connectivity layer is already in place. The messaging framework is already in place. The compliance architecture is already in place. When a bank agrees to participate, payments start flowing almost immediately. Regardless of the bank's size, regardless of its geographic location, the infrastructure handles it. Now think about what that actually means in practice. Finastra is connected to thousands of banks. Every single one of those institutions is, technically speaking, already one partnership agreement away from being live on Ripple's payment infrastructure. The switches are already wired in. We are waiting for banks to flip them. Brad Garlinghouse has spoken about 1,000 small switches being turned on one by one. What Finastra represents is not one switch. It is a master panel connected to thousands of switches simultaneously. The adoption curve, when it moves, will not be gradual. It will be sudden. This is the part of the XRP story that generates the most debate, but it deserves a serious analytical look. Consider this timeline carefully. In late 2017 and early 2018, XRP reached over $3. At that point in time, Ripple had almost no significant bank integrations, almost no institutional partnerships at scale, very limited real-world transaction volume, almost no regulatory clarity. Now consider where we are today. Ripple has formal partnerships with hundreds of financial institutions across dozens of countries. On-demand liquidity corridors are live across multiple continents. XRP has been formally classified as a digital commodity by US regulators. A Ripple Bank charter application is in process. Major banks are publicly acknowledging they need third-party blockchain infrastructure providers. The DTCC is moving $110 trillion toward tokenization. And yet, XRP is trading at a fraction of what its fundamentals would suggest. Some serious analysts have raised a logical question. Was XRP price intentionally kept range-bound during the years of regulatory uncertainty to allow infrastructure to be built quietly before the price reflects actual institutional demand? We are not presenting this as confirmed fact. We are presenting it as a logical framework worth examining. Because if the answer is yes, then what comes next is not a normal crypto bull cycle. It is a deliberate revaluation. And the timing, based on everything we are seeing right now, points toward that moment approaching. Let me bring all of this together for you. A $37,000 trade once moved XRP to $50, proving that thin liquidity and institutional volume are mathematically incompatible. Banks will need pre-funded XRP liquidity pools, not passive on-demand access. When institutional adoption begins at scale, the supply shock will be unlike anything the crypto market has ever seen. The DTCC just confirmed that $110 trillion is moving toward blockchain settlement. Finastra has already wired thousands of banks into Ripple's infrastructure, waiting for the switch. And XRP, the only asset to survive a 4-year SEC lawsuit while maintaining a top 10 market position, is classified by US regulators as a digital commodity. The political noise is real, the regulatory delays are frustrating, but the mathematics underneath all of it have never pointed more clearly in one direction. Stay informed, stay patient, stay positioned. If this breakdown gave you value today, hit subscribe to XRP Verified. I cover these developments every single day, so you always know what is happening before the rest of the market figures it out. I will see you in the next one.